I do not know whether to call these laws of investing, rules of investing, or observations of investing. But having said that, let me call them observations of investing, because it is definitely an observation. So let me start with the first one, that the ideal price for any product does not really exist, because it depends on each individual what they can do with that price. For example, in 1991, we saw a share called Mazda Industries, which was available at 10 rupees. And we thought, oh, this will definitely pay a dividend. So we were the so-called value investors who did not know the word value investing. Yeah, of course, we had, I read about Graham much after I started investing, right? So we bought Mazda Industries at 10 rupees and then watched it go right up to 1600. I don't remember if it crossed that. And we sold at various prices, but the best price I got was about 1200 on the way down, not on the way up. So, yeah, but the question that I'm driving at is that 10 rupees, if it was a good buy, why did the market allow the price to go up? And if it was maybe 1600 was the right price, then why did the market keep it at 10 rupees also? Of course, we saw the march, almost uninterrupted march from 10 to 1600, going down a little bit and then going up. Harshad used to be a very poor buyer. He would just keep buying. So which means you knew you had to do nothing. You had to just go long in the morning and short and sell it off in the evening. You would make money. Unlike other buyers, I do not wish to name them because they are still alive and active, who would buy, would sell, would wait, would tire you out before they completed the acquisition, and you suddenly are doubtful whether they are really going to acquire. But yes, price was something which was, I'm convinced it was manipulated, but we sitting there in the market, actually physically sitting there also, could not decide what was a good price. So obviously at some stage in every market, some shares get overpriced and some shares get beaten down dramatically. Like case in point, you have DMart available at a high price and you have BHEL which is beaten down from 400. I remember seeing BHEL at 400 at some stage of my life. I'm sure it went above that also, but from 400 if you beat it down to 20 rupees, you know that at 20 there will be some reaction from people to say, well, at this price I can't go wrong with BHEL, and people will enter. Now, I'm not getting into whether it is right or wrong, but that is bound to happen. So this is what happens. Market overshoots its optimism and overdoes the pessimism also. So today also there is nothing called the perfect market. There is nothing called the perfect index. And at every point in time, at least in the Indian market I have seen, is you have some shares which are worth selling and some shares which are worth buying. So on a particular day, you could be doing both, buying and selling. You could be selling DMart saying, oh God, this is overpriced, I don't want to hold, and buying BHEL saying, oh, this is tremendously underpriced, I'll happily buy it at 20 rupees, right? Both happening on the same day in the same market. This can happen, right? And it does happen day in and day out. Some industries overshoot and some industries lag. If you can buy the laggard and know when the laggard will turn around, you can get it more perfectly. But the question is first, yes, the market will do this. When I think it was John Templeton who said markets are coming down means they were expensive, markets are going up means they were cheap. It's so true. It's true that prices, even about equity prices, a basic rule of economics. When does price go up? When the demand is greater. When does the price come down? When the supply is greater, right? It's as simple as that. So it's a question of demand and supply. So obviously prices will never be at an equilibrium. Price will go, it will look expensive and therefore it will come down. Then price will go very cheap and then people will start buying, therefore the price will come up. So equilibrium will be found, but at no point will all share prices be in equilibrium in all markets. That is impossible, right? So many people are at play in the sense that somebody is buying for the long term, somebody is buying for the short term. So all kind of investors, traders, etc. Somebody buys and says, I will not sell it for 20 years. Somebody says beyond 20 minutes is difficult. All these people are in the same market. So we all together decide the price, and we also realize that when you are calm and nothing is happening in the market, something will give and you will either go down or you will go up. 2000 to 2019. Equity markets did nothing in India. They were just going up consistently at a particular pace. It looked like PPF on steroids, right? Nothing, no standard deviation. But come 2020 and you are given a lesson in volatility, right? So when you are calm, you are sowing the seeds for there to be a violent market. So these markets have been violent markets. Markets will never crash fully. Some parts of the market will crash. So even if you see 2007, what crashed was infrastructure, power, software, some of these companies which were crazily dealing at a PE of 100, they are the ones who suffered. But having said that, in 2020, if you thought the pandemic, it is those companies which are overpriced and highly priced which will suffer, you got it completely wrong. It was these shares actually went up even further in the US, right? So the problem with investing is, for every rule that you bring to me, I can bring you a counter rule saying, well, this is what happened in Japan in this year, this is what happened in France this year, right? So all these things keep happening. You need to remember that. Everybody about compounding will say, oh, you had to just invest 15,000 rupees per month from your first job. But remember, for many people who are hearing this, 15,000 was not even their take-home salary. Maybe their take-home salary was 4,000 or 3,000. There is no way how we could have put an amount 3 times that or 4 times that in a SIP. So people need to remember that if you give old examples, you need to give small numbers. Numbers are not 15,000 rupee SIPs could not have been very common 20 years ago, right? There will always be a mismatch of cash in the people who know that they have to invest and who are say 45, 50 and not having enough time for compounding, and their children who are 21, 22 who again don't have too much money, but for them also you need to tell them that, well, if you start investing now, start investing big amounts now, it will be good for you in the long run. The amount of money that you will make in equities is more a function of your stomach being able to take it rather than your brain being able to say that this share is worth buying, right? The best thing about the market is different people are playing the market. So somebody is playing it for a short run, somebody for a long run, somebody for an ultra long run. So that is the reason why you get a ready-made price, because of huge supply and a huge demand. Different time horizon, somebody for a few weeks, somebody for a few months, somebody for decades. Everybody is in the market. Somebody who thought he was there for the decade suddenly needs money, so he is selling it off. Somebody who has the shares and who says, oh, I don't have any other opportunity, suddenly finds an opportunity, so he sells off. So there's no logic for every, it's not that every share transaction happens with rationale. Somebody who needs money to put up his factory is not going to look at what is the IRR which has happened and when I should remove. He wants it removed now, right? When we say we got lucky, what it means is we avoided some big risk. Now take a case where a person starts investing at a young age and then suddenly is stuck with some illness and is unable to earn money. What happens? For example, you have your physical injuries, you have your mental injuries. It is physical injuries which are visible and help will be offered. Mental injuries are not even recognized, right? Thank you.